What are brokered CDs? All right, I'm a huge fan of brokered CDs. So we're going to jump into Schwab here, and we're going to say, did you know you can trade CDs and even treasuries online? Now, I just did a video I don't know, a couple hours ago about Schwab. How it's awesome for bonds and stuff. We're going to talk about CDs now. So let's check this out. So here are the range of CDs: 3.39 for 3 months to 4.5 roughly for 5 years to 4.8 for 10. The interesting thing was a guy posted yesterday. He goes, why would you do a fixed annuity? I can't remember what the rate was when you can get a CD roughly the same. I said, can you get those CDs at roughly the same price? So, and sure enough, you can. It's crazy. Now, look, I literally don't care if you do an annuity or a CD. It doesn't matter to me. I think the annuity was paying 5 and the CDs are paying 4.5. But it's funny because I looked at PenFed. I'm like, there's no CDs for 5 years that are paying 4.5. So I said, where are you getting 4.5 CDs? And sure enough, I went to Schwab, and here you go. So let's check this out. So here we got a list of certificates that have a yield to worst 4.5, 4.5, 4.5, roughly 4.4, but still 4.5. JP Morgan, what does that say? 3.45 is the coupon that matures 2027 as a callable date. And these are where I don't want to say call, but you got to know what you're buying here. All right. We're going to dive into this one real quick. American Commercial 4.3% CD. The coupon is 4.3. The current yield is 4.52, and the yield to worst is 4.52. All right. So what this means, it has a coupon of 4.3. All right. But the yield to worst is higher than the coupon. What is happening to the price? It's lower. All right. So basically, this bond has, I bet that's a callable day right there, 12/29. They could call it at 100. I bet they probably don't. But anyway, we'll go into this here in just a second. We'll do a non-callable ones. But this bond could be called at 100. All right, you're only paying $98.99. So basically $99 for 100. If they in December, if they call it at 4.3, they're going to pay you $100, even though you only bought it for 99. So you're going to get a $1 increase in your principal. In the interim, you're still getting the 4.3% coupon. Hope that makes sense. So the only reason they call the bond is if interest rates dropped. If interest rates drop, they call it because they say, we don't want to be stuck paying you 4.3 when current rates are 2. I don't know if that's going to happen. I don't expect that to happen too much, but it could. Either way, but you're protected on a callable. Now, I want to show you something here. Let's keep going. So this is American Commercial. I don't know what that is. I assume they're all FDIC insured. It pays quarterly. I want to go down. But let's look at the difference here. HSBC Bank. Now these are all FDIC insured, so the credit risk is the same. The government, FDIC, Federal Deposit Insurance Corporation, not the government. I should not say that. Guarantees these bonds for what, $250? But I want to show you something here. Look at this. Yield to worst, 4.478. Pretty close, man. The 4.5 is the yield to worst. This has a coupon of 3 1/8, 3.125. Huh. This has a price of $93. Callable date 100. What does that mean? If rates drop below 3.125, it's actually called 3 1/8. They're going to call this bond from you. They're going to pay you $100 for the bond that you just bought for $93. In the interim, you're getting 3.125 a coupon. I want to point something out here. If you put $100,000 into this bond, all right, you're getting $3,100 in income. That's it. If you put $100,000 into this bond, you're getting $4,300 of income. Now, at the end of maturity, you're going to get $100 back either way. They both mature at 100, or if they're called, they both are called at 100. But for income purposes, you're actually going to get more income off the higher coupon bond, even though the price is higher, because this pays you more money. You'll get more at maturity because you're buying it for 93. It's going to mature at 100. It's kind of like I don't want to call it a zero coupon, but it's kind of like that. A zero coupon doesn't pay you any income. It just says, I'm going to buy a $100 bond for $75. I'm going to buy, it'll mature 10 years. I'll draw this out for you. I think it's helpful. So a zero coupon bond works like this. And these are certificates. These are callable or brokered CDs. They're just like bonds. I'm buying $75. I pay $75 for a bond. and matures at 100. All right, whatever your yield is on that doesn't matter, because basically all that says is, I mean, it matters, but you're basically saying I'm paying $75 today, knowing full well at some point in the future I'll get $100 back. Thus, I'll get $25 of appreciation, if that makes sense. It's not like a capital gain, but still. The drawback about zero coupon bonds is what they call phantom income or something like that, where you got to pay tax on that phantom income. Either way, if it's in an IRA, you don't. Same thing's happening here, though. All right, so we got one bond that's cost you $93. It will mature at 100. All right, $93 can mature at 100. In the interim, I'm getting what I get 3.125%. All right, so I'm getting 3.125% of income. There's 4.5. I'm still getting a 4.5% yield, but my income isn't this. It's this. I hope this makes sense, because if you're buying a 4.5 bond that's yielding 4.5, you're not getting 4.5 income. You're getting 3 1/8 income. At maturity, you'll get the $7 back. So you buy 93, it matures at 100, but you don't see that till maturity. You following that? On the other hand, if you have just get rid of this 4.5. We'll say these both are yielding 4.5. You got a $99 bond. It matures at 100. You only get $1 in appreciation, but in the interim, you're getting 4.3 interest rate. 4.3 interest rate. All right. So if income is what you're looking for, you want to get the one with the higher coupon, even if you got to pay more for it. All right. Now I want to show you something else here too. Let's see if we can't find. Yeah. I mean, so anyway, I want to see if we can find a bond that's trading higher than the call price. Oh, that's that. That's new. Yeah, there you go. Newly issued one right there. So they just issued this guy 4.45, 5-year certificate. Pretty simple here. They literally just issued this. There is no yield to worse because it's trading at $100. It'll mature at $100. I can't tell if it's callable or not, but it's 5. Yeah, 5. Look at that, perfect. 5-year 4.45 from Discover Bank. I don't get why these banks are. It's weird to me because the credit unions, like Navy Federal Credit Union, doesn't have a. Let's take a look. I don't see anything. Hold on. Yeah, here's the Navy Federal 3.45, and it's a credit union, which means they don't pay tax on their income. I don't. Why is that so low? Let's go to PenFed. That's weird, man. Why is like Discover Bank, Capital One? I know these are credit card banks, but are we? Discover, Capital One. Let's look. Check this out. Synchrony Bank. I don't know what the hell that is. BMO Bank. I bet these are big. Discover, JP Morgan. I bet these are big credit card processors. I bet Live. I don't know what the hell Live Oak is. Pablo. I bet it's a big credit card machine. Are we friggin' giving these guys? Are we giving them FDIC insurance where they can issue payable CD, high interest CDs, so they can go around and usury take advantage of high interest rates on credit cards? Man, the bank insists. I think that's what's happening. They're saying, look, I'll issue a 3.5 because I can loan it out on a certificate with under FDIC insurance. I can loan it out on a credit card at 18. I bet that's freaking evil, dude. All right, let's see this one right here. Look at this guy right here. $85 it trades at. There was one that was like 82. So $85. Live Oak. 0.75 is the interest rate. Still got 5 more years to mature. 227. 0.75. Your coupon is 0.75. That means for every $100,000 you put in, you're getting $750 a month. Now you're only buying it for 85. All right, so you're going to get $15 of appreciation at maturity, but that's 5 years from now. So you're getting 3.9. Why would you do that? That makes literally no sense at all. I can come up here and buy this other one at 4.4. Why would I buy? This is stupid. I mean, you get $85 is, again, it's a somewhat of a zero coupon bond. You're paying 85 for bonds can mature $100 or a CD in 5 years, but in the interim, I'm getting $750 on every $100,000. Don't do that. I'm looking for one that trades well above par. So let's see here. Hold on a sec. Yeah. Like UBS Bank, Santander, I don't know, not much above par. I did the video on bonds a couple hours ago where I showed you buying something above par. All right, man. Let's just go back here. Let's CIT Bank. We're just going to look at the what the things are here. Let's see what we got. Matures in actually. Let me do. No, don't really have anything above par. This JP. Let's click on this one right here. So it's one second. See, as this pays semi-annually, only twice a year. You get 4.25, but twice a year. This one right above it pays monthly. It's paying 2.95, but it pays monthly. The yield to worst is, this is yield to maturity, 3.96. Yield to maturity is 4.229. If I want income, I'm buying this one. It has a callable date, 2023, so in 6 months. I'd lose 2 cents if they called out. Highly suspect they won't call it out because interest rates have gone up relative to when they issued this guy. And let's see when they issued it. Hold on a sec. All right, so it looks like they just issued a couple weeks ago. All right, so anyway, this is a 2-year certificate. You're getting 4 point something. I forgot what it was. 4 point callable. Basically 4.2. Yeah, 4.25. All right. So what does all this mean? They can call whenever they want. When interest rates go down, they'll call it to basically refinancing of their debt is all there is. If interest rates go up, they're not going to recall it. If interest rates go up, you can sell that bond and take your proceeds and buy another CD and take your proceeds and buy another CD. But you're not going to be able to sell it for what you pay for because other people, no one wants your certificate of deposit if it's paying less than competitive rates without a significant discount in price. And again, we refer you back to that one CD that was paying, well, here's one for 94. All right, it's only paying 0.45 as a coupon. No one was going to buy a 0.45 coupon where I'm only getting interest twice a year. Unless I got to pay a significant discount in the price. And here you're only paying $94. I wouldn't touch that with a 10-foot pole. No reason to. You only get 0.45. What's the point? If you're trying to get income, this is the way to go. Now, the nice thing about brokered CDs is notice there's no surrender charge. It's a security, literally security. You sell it and you buy it. You put a bid, you put an ask. There's no surrender charge. Now, in somewhat, there is a surrender charge calling, I have to sell my bond at $94. Well, I bought it for $100. All right, that's a surrender charge, but there's no penalty to break the bond, nothing like that. I'm a big fan, man, and right now they look pretty. I think these brokered CDs look pretty good. If you get 4.5 on a CD, and I'm very. I think it's not. I think it's a pretty good deal. Pretty good deal. I'd be taking advantage of that if I had some cash laying around. I don't because I got to pay the tax, man. Love your thoughts. Excuse me. We'll see you.